Fibonacci fan lines are trend lines based on Fibonacci retracement points. Rising fan lines extend up from a trough and pass through retracement based on the advance from trough to peak. These fan lines can then be used to estimate support levels or potential reversal zones. Falling fan lines extend down from a peak and pass through retracements based on the decline from peak to trough. These fan lines can then be used to estimate resistance levels or potential reversal zones. Rising Fibonacci fan lines will be drawn based on the following rules. Fan line 1. From trough to 38.2% retracement. Fan line 2. From trough to 50% retracement. Fan line 3. From trough to 61.8% retracement. Chart on the screen shows the S&P 500 ETF with rising Fibonacci fan lines. The lines are based on the March 2009 trough, or low, and the April 2010 peak, or high. The horizontal pink lines show the Fibonacci retracements tool extending from trough to peak. It takes 2 points to draw a line. The first point for each fan line is based on the low. The second points are based on the Fibonacci retracements. Notice how the Fibonacci fan lines start from the trough and pass through these Fibonacci retracements, shown by blue arrows. Falling Fibonacci fan lines will be drawn based on the following rules. Fan line 1. From peak to 38.2% retracement. Fan line 2. From peak to 50% retracement. Fan line 3. From peak to 61.8% retracement. Chart on the screen shows the S&P 500 ETF with falling Fibonacci fan lines. The lines are based on the April 2010 peak, or high, and the July 2010 trough, or low. The horizontal pink lines show the Fibonacci retracements tool extending from peak to trough. It takes 2 points to draw a line. The first point for each fan line is based on the high. The second points are based on the Fibonacci retracements. Notice how the Fibonacci fan lines start from the peak and pass through these Fibonacci retracements, shown by blue arrows. Chart on the screen shows a stock with the Fibonacci fan lines extending up from the July low to the October high. The stock bounced off the 38.2% fan line in late October and then moved to the 61.8% fan line in December. The stock ended its correction at the third fan line and moved back above 65. There was another pullback into February and the stock again reversed near the third fan line. This chart was drawn with an arithmetic scale. Chart on the screen shows a stock with the Fibonacci fan lines extending up from the March low to the July high. The stock declined sharply in August, but found support at the 50% line later that month. The first bounce of the 50% fan line was short-lived, but the stock found support again at the 50% line in early September. This chart was drawn with an arithmetic scale. Chart on the screen shows a stock with the Fibonacci fan lines extending down from the April high to the May low. Chartists could draw the lines once the stock began its bounce in late May. The stock subsequently met resistance between the 50% and 62% fan lines. The stock moved to a new reaction low in early June. Once the prior low is taken out, it is usually necessary to redraw the Fibonacci fan lines based on the new low. Chart on the screen shows new fan lines with a stock hitting resistance between the 50% and 62% lines. The choice of scaling can change the slope of the Fibonacci fan lines, which in turn will alter potential support, resistance and reversal levels. Log scaling treats price changes as percentage moves. A 10% move from 6, which is 60 cents, looks the same as a 10% move from 60, which is 6 points. By contrast, arithmetic scaling focuses on the absolute change. A $1 move from 6 to 7, which is plus 16.66%, looks the same as a $1 move from 12 to 13, which is plus 8.33%, even though the percentage change is double. On a log scale, the 16.66% advance would appear twice as large as the 8.33% advance. Chart on the screen shows a stock with an arithmetic scale. Notice that the price grid is equally spaced. The distance between 6 and 7 is the same as the distance from 12 to 13. For longer time periods, however, log scaling is generally preferred to accurately depict big price movements on long-term charts. The stock advanced from 5 to 12 in less than 4 months. This move appears sharp on the log scale because the percentage move from low levels is large. The move looks less steep on the arithmetic scale because the absolute change is the same from low levels. The scaling difference does not change the starting point for the Fibonacci fan lines or the actual retracements. The horizontal pink lines show retracement equality. However, because of the scaling, the Fibonacci fan lines on the log chart are steeper and the stock broke the 50% line in mid-April. The Fibonacci fan lines on the arithmetic chart are less steep and the stock broke the 50% line at the beginning of May. So which scale is better? Unfortunately, there is no right or wrong answer. Arithmetic versus log scaling has been a heated debate in technical analysis for many years. It really boils down to a personal preference. Scaling makes little difference with relatively small price movements over short time periods. There is, however, a clear difference with big price movements over longer time periods. Log scaling is generally preferred for long-term charts.